Here is a number that should make every Canadian angry. The standard savings account at Canada's Big Five banks, RBC, TD, BMO, CIBC, Scotiabank, currently pays approximately 0.05% to 1.40% interest on deposits. On $10,000 sitting in a standard Big Five savings account for 1 year, you earn approximately $5 to $140. On the same $10,000 at EQ Bank or Wealth Simple Cash in 2026, you earn approximately $350 to $400. Same $10,000. Same Canada. Same CDIC insurance protection. One pays $5. The other pays $400. But here is the number that actually matters. Canada's Consumer Price Index rose 2.4% in March 2026. According to Statistics Canada, inflation is running at 2.4%. Your Big Five savings account is paying 0.05% to 1.40%. Even the best Big Five rate does not keep pace with inflation. That means the purchasing power of money sitting in a standard Canadian bank savings account is declining every single year. You are not growing your wealth. You are slowly losing it to inflation, while your bank uses your deposits to earn substantially higher returns and pays you a fraction of a percent in exchange. And here is the biggest problem of all. Most Canadians, who were taught from childhood that saving money is the path to financial security, have confused saving with building wealth. They are not the same thing. They have never been the same thing. And the gap between them is where most Canadians' financial futures quietly disappear. This video explains exactly why saving alone will never make you wealthy, what your bank is actually doing with your money while you earn almost nothing, and the 3 specific moves that transform a savings habit into a wealth-building system. Let's start with the mechanics. Most Canadians have never been clearly shown. Because understanding what happens to your money after you deposit it completely changes how you think about savings accounts. When you deposit $10,000 into a Big Five bank savings account, you are not storing your money in a vault. You are making a loan to the bank. The bank becomes the borrower. You become the lender. The bank pays you interest, currently 0.05% to 1.40% at the Big Five, in exchange for the right to use your money. What does the bank do with it? It lends your money out at dramatically higher rates. The average Canadian 5-year fixed mortgage rate in 2026 sits at approximately 4.14%. Variable rate mortgages are priced against the prime rate. Credit card balances are charged at 19.99% to 22.99%. Unsecured personal loans at 8% to 14%. Lines of credit at prime plus 2% to 5%. The spread between what the bank pays you, 0.05% to 1.40%, and what it charges borrowers, 4% to 22.99%, is its profit margin. That spread, across millions of Canadian depositors, generates billions of dollars in annual net interest income for the Big Five. RBC reported fiscal Q2 2026 results with revenue climbing 11% year-over-year to $17.5 billion and net income of $5.5 billion, up 25% year-over-year. CIBC reported fiscal Q1 2026 net income of $3.1 billion, up 43% year-over-year. BMO, TD, and Scotiabank reported similarly strong earnings. The Big Five Canadian banks are among the most consistently profitable businesses in Canadian history. Much of that profitability flows directly from the spread between what they pay depositors and what they charge borrowers. The most important number, Canada's Big Five banks pay a standard savings rate of 0.05%, while the Bank of Canada's overnight rate sits at 2.25%. That means the Big Five are paying depositors approximately 2.2 percentage points below the overnight rate, while lending those same deposits out at rates 2% to 20% above it. The gap between $5 per year and $400 per year on the same $10,000, identified by Wealth North's 2026 analysis, is not a rounding error. It is the difference between a Big Five standard savings account and a competitive online bank paying a fair rate. Both are CDIC insured. The only difference is how much of the spread the institution is willing to share with depositors. Action step: log into your bank account right now. Find the interest rate on every savings account you hold. If it is below 3.5%, you are leaving real money on the table every single month. Moving to EQ Bank or Wealth Simple Cash takes approximately 20 minutes and requires no investment expertise. Here is the mechanism most people understand intellectually, but have never calculated for their own situation. Inflation is not just a number in the news. It is a continuous reduction in the purchasing power of every dollar you hold in cash or low-interest accounts. And it compounds, just like interest, in the opposite direction. The math at current Canadian rates: $100,000 in a Big Five standard savings account at 0.50% interest, earning $500 per year. Inflation at 2.4% in March 2026, meaning the purchasing power of $100,000 is declining by approximately $2,400 per year. Net real return: approximately negative $1,900 per year. After 10 years of Big Five standard savings account, the nominal balance grows modestly. But the real purchasing power, what that money can actually buy, has declined significantly. In nominal terms, you have slightly more. In real terms, you have less. The Big Five standard savings account is not just paying you almost nothing. It is actively allowing inflation to consume the real value of your money while you feel safe because the number is not going down. Groceries in Canada are over 30% more expensive than 2019. Housing costs have surged. The cost of ordinary life has risen substantially faster than Big Five savings rates over the same period. A Canadian who kept $100,000 in a standard Big Five savings account from 2019 to 2026, 7 years, at an average rate of approximately 0.5%, earned approximately $3,553 in interest. In the same period, the cost of a basket of groceries rose over 30%. The real purchasing power of that $100,000 declined meaningfully, even as the nominal balance crept up. The best GIC rates in Canada in 2026, 2.25% to 3.85% for 1 to 5 year terms, are competitive with and in some periods above the current 2.4% inflation rate. A GIC inside a TFSA at 3.85% generates a real return of approximately plus 1.45% above inflation, meaningfully better than standard savings, but still far below what equity investing historically delivers. The Canadian Consumer Price Index, rising 2.4% in March 2026, reflects the afterlife of the inflation surge. The baseline cost of ordinary life has shifted upward and remains elevated. Even at 2.4%, the inflation rate exceeds the Big Five savings rate for most standard accounts. The honest role of savings accounts. They are essential for emergency funds and short-term savings, where capital preservation matters more than returns. The 3 to 6 month emergency fund at a competitive HISA is the correct use of a savings account. What is incorrect And what this video is specifically challenging is treating a savings account as a long-term wealth-building vehicle. Action step: calculate your real return right now. Take the interest rate on your savings account. Subtract the current inflation rate of 2.4%. If the result is negative or near zero, your savings account is not building wealth. It is preserving capital at best and losing purchasing power at worst. Here is the number that makes this concrete for every Canadian. The same $10,000, placed in 4 different vehicles, produces 4 dramatically different outcomes over 30 years. This is not hypothetical. These are the actual historical and current return rates of each vehicle. Vehicle 1, Big 5 Standard Savings Account at 0.50%. $10,000 times 0.50% per year for 30 years equals $11,614. A nominal gain of $1,614 in 30 years. In real inflation-adjusted terms, likely worth less than the original $10,000 in purchasing power. Vehicle 2, Best Competitive HISA at 4.00%. EQ Bank/Wealth Simple. $10,000 times 4.00% per year for 30 years equals $32,434. A nominal gain of $22,434. In real terms, modestly positive after inflation. Vehicle 3, Best 5-year GIC at 3.85%. RateHub.ca 2026. Reinvested at same rate, $10,000 times 3.85% per year for 30 years equals $30,837. Similar to the competitive HISA, meaningful nominal gain, but modest real return. Vehicle 4, S&P 500 Index ETF inside TFSA at 8% conservative annual return. $10,000 times 8% per year for 30 years equals $100,627. Tax-free inside a TFSA. A nominal gain of $90,627. In real terms, substantial wealth creation above inflation. At 10%, the S&P 500's actual long-run average. The same $10,000 becomes $174,494. The difference between the Big 5 Standard Savings Account and a TFSA invested in a low-cost S&P 500 ETF over 30 years on the same $10,000, approximately $89,013 to $162,880 in additional wealth. Not from taking catastrophic risk, from simply moving the money from the wrong vehicle to the right one. The key insight: all 4 vehicles inside a TFSA are completely tax-free. The competitive HISA inside a TFSA and the ETF inside a TFSA pay identical tax, 0. The only difference is the return. And the return difference, compounded over 30 years, is the entire gap between someone who saved and someone who built wealth. Action step: look at how much you have sitting in a standard Big 5 savings account right now beyond your 3 to 6 month emergency fund. Every dollar above that amount, held in a 0.5% account instead of a TFSA ETF, is costing you approximately $89 in lost wealth per $1,000 over 30 years. Here is the part that transforms this video from financial education into financial empowerment. The savings account, specifically the standard Big 5 savings account, is not a flawed product. It is a perfectly designed product. It is designed to do exactly what it does: hold your money cheaply, generate significant profit for the institution, and make you feel financially responsible for doing so. Banks benefit enormously from deposit inertia. The tendency of depositors to leave money in the same account indefinitely without shopping around. Wealth North's 2026 analysis found that the gap between the best and worst savings account rates in Canada is not a rounding error. On a $50,000 balance, the difference between a Big Five standard account and a competitive online bank is nearly $2,000 per year, recurring, compounding, and requiring no investment expertise to capture. The reason most Canadians don't move their savings: the banking relationship creates friction and familiarity. The same bank holds your checking account, your mortgage, your credit card. Moving savings feels like a disruption. The bank counts on that feeling. It is worth approximately $2,000 per year per customer to them. Here is what your bank does not tell you when you open a savings account. First, that the CDIC protection covering your deposits at EQ Bank or Wealth Simple Cash is identical to the coverage at RBC or TD. Both are insured up to $100,000 per depositor per category. The safety difference is zero. Second, that a TFSA holding a savings account earns at the same rate as a non-registered savings account. Moving your emergency fund into a TFSA HISA at EQ Bank does two things simultaneously. It earns 4% instead of 0.5%, and it shelters that interest from tax at a 30% marginal rate. A 4% HISA inside a TFSA returns the equivalent of a 5.7% taxable account. The after-tax advantage compounds every year. Third, that the same bank managing your 0.5% savings account is earning 4% to 22% on the money you deposited. The bank is not your financial partner. It is your counterparty. Understanding that distinction is the beginning of financial literacy. None of this is illegal. None of it is a conspiracy. It is simply business. And the appropriate response is not outrage. It is action. Move your savings to where it earns a fair rate. Then move your long-term wealth-building capital into assets that historically grow. Action step: open an EQ Bank or Wealth Simple Cash account this week. Move your emergency fund there. Enable the TFSA option so the interest is tax-free. This single move takes 20 minutes and produces approximately $1,375 to $2,000 more per year on a $50,000 balance, every year, indefinitely. Here are the 3 specific moves that transform a savings habit into a wealth-building system, in the correct sequence for any Canadian at any income level. Move 1. Maximize the return on your emergency fund first. Before any investment decision, make sure your emergency fund of 3 to 6 months of core expenses is in the highest returning liquid account available. In 2026, EQ Bank and Wealth Simple Cash offer approximately 3.5% to 4.75% on HISA accounts, with full CDIC insurance. The best promotionally rated accounts briefly touch 4.75%. The standard ongoing rate at EQ Bank and Wealth Simple sits in the 3.5% to 4.25% range. Hold your emergency fund inside a TFSA HISA, where the interest is completely tax-free. At a 30% marginal rate, a 4% TFSA HISA is equivalent to earning 5.7% in a taxable account. This single move generates $1,375 to $2,000 more per year on a $50,000 balance compared to a Big Five standard account. Zero investment risk. Zero complexity. Move 2. Redirect every dollar beyond the emergency fund into a TFSA invested in a low-cost ETF. Every dollar sitting in a savings account beyond 3 to 6 months of expenses is long-term capital being penalized by a low-return vehicle. The correct vehicle for long-term capital: a TFSA invested in XEQT or VEQT, a globally diversified equity ETF at 0.20% MER. The historical long-run return, 8% to 10% annually. The tax treatment inside a TFSA, 0%. The minimum investment, $1 at Wealth Simple Trade or Questrade. The time to set up, one afternoon. $500 per month redirected from a Big 5 savings account at 0.5% to a TFSA ETF at 8%. Over 30 years. The difference is approximately $533,680 in additional wealth from the same monthly habit, simply deployed into the correct vehicle. Move 3. Automate both and never think about either again. The final move is the most important. Automation removes every future decision. Set up a monthly automated transfer to your TFSA on payday. Set up a pre-authorized purchase of XEQT or VEQT inside the TFSA. Enable DRIP. Set up a separate automated transfer of the correct emergency fund amount to your competitive HISA. The system then runs indefinitely. The emergency fund earns 4% tax-free. The TFSA ETF compounds at 8% to 10% tax-free. Every month, both positions grow without requiring a single conscious decision. This is the complete system that replaces saving as the primary financial strategy with wealth building as the default. Saving is still happening. The emergency fund is intact and earning a real return. But the long-term capital is deployed into assets that historically build wealth above inflation over time. Action step. This week, complete Move 1. Open a competitive HISA. Move your emergency fund there. Then complete Move 2. Calculate how much you have beyond your emergency fund in low-interest savings. Open a TFSA at Wealth Simple or Questrade. Buy XEQT. Automate monthly purchases. The system is now running. Let's come back to where we started. The Big 5 Standard Savings Account. $10,000 for 1 year. $5 in interest. That $5 is not just a low return. It is the physical manifestation of a financial system that has systematically confused two completely different concepts: saving and building wealth, and trained generations of Canadians to believe they are the same thing. They are not. Saving preserves capital. Building wealth grows it above inflation. The savings account is the correct tool for one of those goals. It has never been the correct tool for the other. Here is the complete picture after 3 moves. Your emergency fund, 3 to 6 months of core expenses, sits at EQ Bank or Wealth Simple Cash, earning 3.5% to 4.75% tax-free inside a TFSA HISA. It is generating approximately $400 per year on $10,000 instead of $5. It is fully liquid. It is CDIC insured. It is now actually doing its job. Your long-term capital, everything beyond the emergency fund, is automated monthly into a TFSA, invested in XEQT at 8% historical average. In 30 years on $500 per month, it builds $745,179 tax-free. Against the Big 5 savings accounts, $185,356. A difference of over $500,000 from the same monthly habit. Canada's CPI rose 2.4% in March 2026. The best Big 5 standard savings rate is 1.40%. The purchasing power of money in a standard savings account is declining in real terms. The S&P 500 has returned approximately 10.3% annually since 1957. Saving money is not the problem. Saving money in the wrong vehicle and calling it wealth building is 3 moves. One afternoon, a wealth building system that runs automatically for 30 years. The savings account was designed to hold your money cheaply for the bank. The TFSA was designed to build your wealth tax-free for you. Use both, in the right role for the right purpose.